Assalamualaikum and hi, Mediwan Shafizah and my fellow classmates. In this video, we will present subtopic on capital expenditure analysis. Before proceed to further explanation on this topic, let me introduce my group members. On the left side is Nur Afrina Aida binti Muhammad Rizli, followed by Nurul Amani binti Abdul Hafiz. On the right side is me myself, Nur Syamiliani Natasha binti Muhammad Nur, and lastly Muhammad Ruzani Akmal bin Abdul Halim. This is the outline on what we cover in this topic. We start with what are capital expenditure, next types of capital expenditure, next how to calculate capital expenditure analysis, and then importance of capital expenditures, challenge of capital expenditure, efficient capital expenditure by practice, and differences between capital expenditure and revenue expenditure, and last but not least, conclusion. Okay, for the first part, what are capital expenditure? Capital expenditure is referring to funds that are used by company for the purchase, improvement or maintenance of long-term assets to improve the efficiency or capacity of the company. Capital expenditure is also known as capex or capital expenses. Capital expenditure include the purchase of items such as new equipment, machinery, land, plant, buildings or warehouse, furniture and also features, business vehicles, software and tangible assets such as patent or license. For the next part, type of capital expenditure. Capital expenditure are long-term investment, meaning the asset purchase have a useful life of more than 1 year. Type of capital expenditure can include purchases of property, equipment, land, computers, furniture, and software. So for the first type of capital expenditure are vehicles. Company often need a fleet of vehicles for distribution or to carry out services for customers, such as delivery companies. These vehicles are considered capital expenditure. However, the costs associated with leasing a vehicle are treated as operational expenses. Second type is intangible asset. Asset for capital expenditure do not all need to be physical asset or tangible, but instead can be intangible asset. If a company purchases a patent or a license, it could be considered as a capital expenditure. For the third type of capital expenditure is building and property. A purchase of or upgrade to a building or property would be considered a capital purchase, since the asset has a useful life for many years. Purchase of property, plant and equipment are often facilitated using secured debt or mortgage, for which the payment are made over many years. Interest expense associated with that financing may be depreciated as well as the cost of the asset. However, costs incurred with an issue of stock would not qualify for depreciation. The fourth type of computer equipment. Technology and computer equipment, including servers, laptop, desktop computers, and peripheral, would be capital expenditure. Lastly, upgrade the equipment. In the manufacturing industry and also other industry, manufactured machinery used to produce goods may become obsolete or simply wear out. Upgrade to the equipment are often needed. If these upgrades are higher than capitalization limit that is in place, the cost should be depreciated over time. It also similar to the buildings or property equipment. Upgrades are also financed. The cost of the financing may be depreciated as well. Hence, the type of capital expenditure vary depending on the industry. For next part, how to calculate capital expenditure analysis. The formula for the capex is the PPE for current period. We will minus PPE prior period and then add on depreciation for the current period. Use the example situation below. When the PPE of current period minus by PPE prior period will be 5,000, then add on depreciation for the current year of 20,000. Then the capex for the year will be 25,000.
Hi, my name is Muhammad Ruzani Akmal bin Abdul Halim. I will be presenting the importance of capital expenditures. First of all, decisions on how much to invest in capital expenditures can often be extremely vital decisions made by an organization. It will help leaders to understand whether an asset offers an attractive rate of return or not. That way, company can balance maintaining existing equipment and property with having enough capital to invest for the company's growth. Capital expenditures are important because of the following reasons. First, long-term effects. The effect of capital expenditure decisions usually extends into the future. The range of current production or manufacturing activities is mainly a result of past capital expenditures. Similarly, the current decisions on capital expenditure will have a major influence on the future activities of the company. Besides that, capital investment decisions are a driver of the direction of the organization. The second important is irreversibility. Capital expenditures are often difficult to reverse without the company incurring any losses. The reason being that most forms of capital equipment are customized to meet specific company requirements and needs. Besides that, the market for used capital equipment is generally very poor, which means acquired assets are likely better off used by the company itself. Then, the third important is high initial cost. Capital expenditures are characteristically very expensive, especially for companies in industries such as production and manufacturing. Capital investment in physical assets like building and equipment offer the potential of providing benefits in the long run, but will need a harsh monetary outlay initially. Besides that, capital costs also tend to rise with advancing technology. Next, fourth important is depreciation. Capital expenditures have an initial increase in the asset account of an organization. However, once capital assets start being put in service, depreciation will begin and they decrease in value throughout their useful life, and may lead to a decrease in an organization asset account. Now, we will move to challenge with capital expenditures. Even though capital expenditure decisions are very critical to the well-being of a company, they create more complexity. First of all, measurement problems. The accounting process of identifying, measuring, and estimating the costs relating to capital expenditures may be quite complicated. For example, the result of boosting the employee morale are intangible and therefore cannot be captured on a balance sheet. Then, the second challenge is unpredictability. Organizations making large investment in capital assets hope to generate predictable outcomes. However, such outcomes are not guaranteed and losses may be incurred. The cost and benefit of capital expenditure decisions are usually characterized by a lot of uncertainty. Thus, during financial planning, organizations need to account for risk to mitigate potential losses. Next challenge will be temporal spirit. The costs as well as benefit related to the capital expenditure are usually stretched over a relatively long period of time for both industrial projects and infrastructure projects. Such a temporal spirit leads to problems in discount rate estimation and the establishment of equivalent, as cash invested in capital equipment is no longer available for potentially more advantageous opportunities. That is all for me. The presentation will be continued by my next team members.
Thank you, Akmal. So I will continue the next part of the presentation, which is efficient capital expenditure budgeting practices. Okay, first of all, why we need to plan the capital expenditure or CapEx effectively? This because due to the substantial initial cost, irreversibility and long-term effect, CapEx decisions are very crucial to an organization. More than that, it's important to create a sound capital expenditure plan to avoid any expense overruns. Investing in CapEx can improve the efficiency of a firm, can allow firms to gain a competitive edge, while at the same time, they may fail to perform as expected, resulting in losses that could have been allocated elsewhere. Therefore, CapEx should be carefully and effectively planned and performed, taking into consideration of all expenses, market expectation, and business growth. So, there are some practices that may help in order to have an efficient capital expenditure budget. The first one is before starting the project, determine its scope, establish realistic timelines, and verify the whole plan has been reviewed and authorized. This because the CapEx budgets need adequate preparations before commencement, otherwise the project may get out of control. For example, when the company wants to consider how many internal resources such as laborers, materials, funds and services that will be required by the project, they should include more detail into the project to acquire more accurate budget. The second practice is long-term consideration, where at the start of the capital expenditure project, the company need to decide whether we purchase the capital asset with debt or set aside existing funds for the purchase. For more understanding, saving money for the purchase typically means that we have to wait a long time to receive the item we want. Borrowing money, on the other hand, will lead to more debt and may limit the borrowing abilities in the future. In fact, both options may be beneficial to the company and different alternatives may be required for the different projects. Next practice is to have the optimal level for the detail, since trying to include too much detail may result in an excessive amount of the time spent obtaining information for the budget, which may be audited by the time it is completed. However, a budget with a little clarity will be indefinite and so unhelpful. So it is wise to find the best possible balance. The fourth way to efficiently plan the capex is to have a good budgeting software. From the beginning of the project, the organization should choose a dependable and practical program to handle the budgeting. The type of budgeting software used will be determined by factors such as the scope of the project, the program speed, and the risk of error. For example, personal capital and mean application which are good to be used by the company who does not prefer complexity. The next practice is forming a clear policy, as capex management in a large firm may include a significant number of people, departments, or even regions, so clear policy should be implemented for everyone to follow in order to keep the budget on track. It also facilitates the decision making, provides consistency and independence, and enhances the effective management and teamwork. For example, a childcare center may have a different policy with a primary school even though they are in the same industry. This means the clear policy are very crucial part in planning capex. Last but not least, to manage the capital expenditure projects effectively, capturing the accurate data is important. Gathering trustworthy information is required to develop a realistic budget and provide useful reports. This because the best data quality ensures that all those who rely on it may have trust in it. Users will be able to produce a better outcome if the data quality is excellent. This enhances the company efficiency while minimizing the probability of negative effects. So that's all from me. Afrina will continue the last part of the presentation. Thank you.
Hi, my name is Nur Afrinaida and I will present on the differences between capital expenditure and revenue expenditure. So before we move further, let's take a look on the brief definition of capital expenditure and revenue expenditure. So as explained by Tasha before, briefly, capital expenditure is funds used on one-time large purchases of fixed assets that could generate revenue on the long term. So in simpler terms, it is an expenses on asset that will be used over the long term. Meanwhile, for revenue expenditure, it is mainly referred to as ongoing operating expenses that are related to specific revenue transactions. In simpler terms, it is a short-term expenses that is used in running the daily business operations. So these are the types of revenue expenditures. The first one is cost of goods sold, then repair and maintenance, utilities and rent, overhead expenses, and employee salaries and wages. There are also other prominent evidence on the differences of these two expenditures. So the first one is, as I explained earlier regarding the differences in timing, capital expenditure is an expenses of fixed assets that will be used and deducted from the statement in the long term. The long-term assets will last for more than a year and will have a useful life of many years. Next, for revenue expenditure, the expenses are only for the short term, which lasts within the period of 1 year. They are the short-term operating expenses that covers the cost of running the daily operation of business. Subsequently, on the size of the expenditures, capital expenditures more often expensed in larger monetary amount than revenue expenditure. This is due to an expenditure is only classified as capital expenditure if it reaches a certain amount of threshold. If not, then the amount will be classified as a revenue expenditure. So for revenue expenditure, the size of monetary amount is definitely smaller than capital expenditure. However, there is some circumstances that a large amount of expenditure can still be classified as revenue expenditure. The transaction will be classified as one if they are directly associated with revenue transaction or they are period costs. So period costs are costs that could not be capitalized into prepaid expenses, inventory or fixed assets. Lastly, on the accounting treatment of the expenditure, capital expenditure will be recorded under cash flow statement to see the cash outflow and inflow of the transactions on the fixed assets in a particular period. The transaction must also be recorded within total assets of the balance sheet. Since the fixed asset provide future benefits through years, the full cost cannot be deducted under the current year the expenses is incurred. The cost should be deducted through depreciation over useful life, which means that it will be expensed over many years. The accounting treatment for revenue expenditure differs with capital expenditure. The revenue expenditure is recorded under income statement. These expenses will be deducted under the revenue until it arrives at the net profit of the accounting period. For revenue expenses, it can be fully tax deducted in the same year the expenses occur. The expenses can reduce the taxable income for the tax period. Next, I will pass the presentation to Shamini and Natasha to conclude our topic.
Lastly, for a conclusion, we can conclude that capital expenditure, CapEx, is a payment for goods or services recorded or capitalized on the balance sheet instead of expense on the income statement. CapEx spending is important for companies to maintain existing property and equipment and invest in technology and other assets for growth.